A simple plan is built for smaller employers who want low admin hassle. The big gatekeeper is the 100 employee rule. You qualify if you had 100 or fewer employees who earned at least $5,000 last year. And there's a second trap. You generally can't run another retirement plan at the same time unless it's a separate plan for a union workforce. On the EA exam, they love those two eligibility restrictions. Once a business adopts a simple, it must cover each eligible employee. Eligible employees can't be excluded just because they don't want it. But here's the twist. Employees can choose to contribute nothing in a given year. Simple IRAs are also lighter paperwork than many plans. No annual Form 5500 filing for the employer. That no Form 5500 fact is a favorite quick hitter on exams. A simple IRA contribution has two pieces: the employee's salary reduction deferral plus a required employer contribution. And each year, the employer must choose one of two employer methods. Method 1 is a match, dollar for dollar on the employee's deferrals up to 3% of compensation. Method 2 is a flat 2% non-elective contribution for each eligible employee, even if the employee defers nothing. The match method has a cash flow safety valve. The employer can reduce the match as low as 1%, but only in any 2 out of 5 years. That's an exam-style detail. It's not whenever you want. If the business wants predictable costs and wants to benefit even non-participating employees, the 2% non-elective method does that, because it applies to every eligible employee, regardless of deferrals. Secure 2.0 added a boost for some simple IRA deferrals. Employees may be able to contribute an extra 10% on top of the existing limit if the employer is small enough. It applies if the employer has fewer than 25 employees. Or, if the employer has 26 to 100 employees, it can still qualify, but only if it agrees to richer employer contributions, a 4% match or a 3% non-elective contribution. Two timing rules show up constantly. First, the setup deadline. A simple IRA can be established effective any date from January 1st through October 1st for that year. Second, the growth rule. If you later exceed the 100 employee limit, you don't instantly lose the simple. You generally get a 2-year grace period to transition to another plan while continuing the simple during that window. What is the latest date that a business can establish a simple IRA for its employees? The options you'll see include mid-September, October 1st, year-end, and even April 15th. Focus on the rule for when a simple IRA can first become effective for a calendar year. Think about it. The correct answer is October 1st. A simple IRA generally must be established effective no later than October 1st of the year. December 31st is tempting because it's a common tax year deadline, but simple setup is earlier. The key exception is a brand new business formed after October 1st. It can set up the plan as soon as administratively feasible. Summit Climate Solutions has 110 employees and all earned more than $5,000 last year. The company wants to establish a retirement plan. Which plan type is not allowed? A 401k, a defined benefit plan, a SEP IRA, or a simple IRA? Anchor on which plan has the strict employee count eligibility rule. Think about it. The correct answer is this simple IRA. Simple eligibility generally requires 100 or fewer employees who earned at least $5,000 in the prior year. With 110, they're out. A 401k, a defined benefit plan, and a SEP IRA don't have that same 100 employee cap, so there's still possible choices. The exam loves testing that hard, simple cutoff.